Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a senior manager here at Schwab, and this is trading covered calls and short puts. And does it ever feel like, man, those premiums just aren't like they used to be? I'm not getting as much income from my covered calls or from my short puts as I typically do. Yeah, prices certainly go up and down, premiums go up and down. Why does that happen? And why might it be actually okay? We're going to be talking about the influences on the general pricing of options, why sometimes it's more of a seller's market for options, and why for some people, they're totally fine selling calls and puts in what might be called a buyer's market. Should be a really good discussion. A lot ahead of us. We'll set an agenda for just exactly what we're going to cover in just a moment. But let me first of all say hello to everybody out there who's already chatting in. Great to see Life in the Fast Lane, Amy, Dom, Will, Scott, Eva, Ted, Leon, Kevin, Sharon, William, everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation, but be aware that you're invited to join us in the live discussion. This is a Monday webcast series, kicks off promptly at 2 Eastern. We'd love to have you here in the live stream. And I also want to let our live stream audience know that my very good friend Barb Armstrong is going to be hanging out in the chats with us. Barb's going to be addressing any questions that I can't get to as long as they're not too far off topic. So thanks for having my back there, Barb. And Barb and I would also like to issue an invitation to you to follow us on X. I noticed there in the chat, had a chat member saying, boy, Barb, you do a great job on X. She really does. And it's the best place to connect with your favorite presenters in between the live streams. So if you have an account on X, give us a follow. You can follow Barb at Barb Armstrong CS. You can follow me at Cameron May CS. But let's get into this. We're going to be doing a covered call today, but I want to talk about why the options premiums just aren't what they have been in recent weeks and months, and why some traders might be perfectly okay with that. But before we do, of course, we have to pause to consider the risks associated with investing. Risk certainly applies to options trading, so bear this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Investing involves risks, including the loss of principal. Schwab does not recommend the use of technical analysis as a sole means of investment research, and any investment decision you make in your self-directed account is solely your responsibility. All right, so let's set the agenda for the day. In this webcast series, we demonstrate market concepts using example trades. So we need to go have a look at the trades that are already in the portfolio. That'll be the first thing we'll do. We'll take a look to see if any of our existing trades need some attention. I think a couple of them probably do. Then we're going to take a quick peek at the markets. And I wanted to talk about gauging what's happening in the stock market, which is a big piece of trading covered calls and short puts, but also what's going on in the options market. Why might some say, this isn't really much of a seller's market today, as this webcast is being recorded, and why others would say, I'm totally fine with it. And then finally, we're going to be planning and placing a new covered call trade within the context of today's market environment, and we're going to be placing another example trade in the portfolio. So a lot to talk about. Let's go right to the Thinkorswim desktop trading software platform. And here are our existing positions. So we have 6 right now. Let's go through them relatively quickly. Last week, we talked about, we added AbbVie and XOM to our portfolio, talked about the timing, maybe when to buy the stock, maybe when to sell a covered call if that's the intention of the trader. And so we wound up with 2 stock positions on which we don't have a call just yet. So one of these we're going to add a covered call to. So the first one is going to be ABBV. Here's what's going on with AbbVie. You can see last week we noted that it had just broken up through a price ceiling. Maybe a trader thought it was going to go for a nice run, and they chose not to put on a covered call and limit the upside potential, at least for the time being, on that stock. And since we added that position, stock went up a little bit. It's kind of sagged back. It's pretty much just a little bit of a break-even level at this point. So let's say our trader looks at this and they think, well, it hasn't made the move that I've anticipated just yet, so I'm not going to add the covered call just yet. And that's what we're going to be doing today. Let's leave that AbbVie position just as a long stock position. So we bought that at right about $190, and you can see it's still trading right about $190. We're down a little bit on that position. The XOM position, on the other hand, we also bought the stock here on a bounce off what appeared to be a support level, a price floor. We had what appeared to be a bullish hammer pattern. And maybe the trader thought prices were going to go up again and again, chose not to put a cap on the price appreciation potential of the trade just yet. Well, in this case, the stock's done a pretty good job of rallying higher, might be approaching a near-term ceiling. And as we discussed last week, that's just sort of the time when some traders actually do choose to sell a covered call. If they think the stock price is going to struggle to go much higher, they might see that as an opportunity to add some income to the equation. So let's do that. Looks like our recent high here is around 113. I wonder what we can get right now for maybe the 115 call. Let's see. Let's go to our trade tab. And how about we put this one out, going back to our charts. Let's put this out to the March 21st expiration. We already have a number of trades that are expiring February 21st. So let's go out to that March cycle. Go out to the 21st of March here. And if we look at the 115 call, that looks like it's trading around 117 to 122. Maybe we can get $1.20 for that. That's a little bit north of 1%. We talked about trading the 1% rule. Not everybody does that, but we talked about that in a recent webcast. You can check that out in the archives. By the way, if you don't know where the series archives are, make sure, first of all, that you've subscribed to our Trader Talks channel, because this is where we host our previous webcasts and our live webcasts. But you can find the playlist for previous webcasts right here. So I can click on that playlist and scroll down. You're going to have to scroll down a little bit. We have a lot of these webcasts. And just look for my face, and you'll find there's trading covered calls and short puts. And if I click on the view full playlist, you can see last week's discussion, the week before that. Here's that 1% rule discussion. So all of this has been captured. It's been posted for posterity there. You can go back and revisit it, okay? But let's maybe look at selling that 115 call. We're getting into a contract here. This just to recap the logic of a call. We're looking to collect some premium, collect the potential income, but in exchange, we're entering into a legally binding contract where somebody's going to have the right to buy shares from us for a fixed price. And in this case, the price is $115 for a fixed period of time. And in this case, it'll be out through the 21st of March or for the next 39 days. So I'm going to click on the bid price here. Now we just have 100 shares. So as I click on the bid price, we want to make sure that we're only entering an order for one contract. It should say -1. So selling one of the XOM 21st of March of 2025, 115 calls. And it looks like the price is snuck down a little bit, which means maybe the stock price has come down a little bit, made the call options a little bit less pricey. But let's see if we can get $1.17 from this. That's what I'll enter as my limit. Let's click on the little lock, which just locks in that price as the minimum that we're only willing to accept. And let's click confirm and send. So we're going to sell that one XOM 21st of March 2025 115 call, trying to get $1.17 for this. There's not a guarantee that a limit order will fill. We'll see if we can get it done. Max profit, max loss. This is as though we didn't own the stock. Notice it says max loss potential is infinite. That would be true if we didn't own the stock. If we had an obligation to sell shares that we didn't own, yeah, that could introduce an unlimited or infinite risk. But if we're able to collect the $1.17, that's $117 of potential income minus the commission here, leaving us with a credit of at least $116.35. Let's see if we get this filled. I'm going to click send. Okay, we sold it actually for the $1.20 that I was discussing a little bit earlier. Okay, so we've just added that trade, and the logic here being, again, let's draw that in above today's price. Let's go up to 115, carry that over to expiration. This is just to represent our contract. That's just kind of showing that we have kind of a price ceiling here. We own the shares. If the price is going up, someone now has the right to buy those shares from us for 115. We bought those shares at a lower price. So if the contract is assigned, that would be a realized gain on the stock plus the 120 premium that we just collected. We'll see how this trade plays out. All right, so that's AbbVie and XOM. We also have a Johnson & Johnson covered call position. We bought shares at 100. For those, we'd like the shares to go up in value, but we sold the 155 call for the 21st of March. So here the preference is probably for the stock to stay below 155. And if you'll notice right now, it's at 153.61. Mark means the market price of the stock. So it's doing just what we might hope it would do. Going up, helping out the shares, but staying below the 155 level. So it's still a little bit out of the money. Even out of the money, though, the shares could, that contract could be assigned. The other trader might decide to buy those shares from us, in which case we bought the shares for 142.5. We sold those shares at 155. That would be a realized gain on the stock. So we're going to let that one seems to be working just fine. We're going to leave it alone. Right now we have an unrealized profit of $1,100 on that trade. Going on to NVIDIA, this one we sold a 110 put. It's a bullish strategy. With this sort of a trade, the preference for the trader is for the stock to go up. It's a bullish trade. We'd like to see that contract expire worthless. We originally collected $1.12. We're hoping to see that just decay down to zero. Right now, it looks like we might be able to get out for about 19, maybe 20 cents. So if we're paid $1.12 to get in, if we can get out for 20 cents, you can see that could be a nice realized gain. What should we do here? Let me throw this here up on the chart. We also have a position in NVIDIA in another one of my webcasts. That's what all the boxes and lines represent. But for this trade, here's what we might want to most keep in mind. Right down here is that 110 level. Someone has the right to sell shares to us for $110. Those shares are worth way more than that. So right now, do they have motivation to sell those shares for 110? Probably not. Most likely, the strong probability is this contract just expires worthless if we leave it alone, in which case we'd be able to keep the full 112, which would be an additional 18.5 cents at this point of gain. But Robert and Dave are saying, let's get out of this, because we'd have to wait another 11 days to maybe make that additional 18.5 cents. That's $18 basically that we could make if we hang around. Also, we could avoid the commission if it just expires worthless. But as long as we have this position, we do have an obligation. Someone has the right to sell shares to us for that $110 price, and that's going to be tying up cash. That we have to have some cash dedicated to the potential purchase of those shares. So $18 left we could make. Trader might need to make a decision here. Should we just get out, take what we can get, most of what we originally stood to make, but not all? Or should we leave it in there? There's a high probability if we just leave it alone, we're going to be making more money on this trade come next week. So there are pros and cons. I think what we're going to do today is just close this one up. Let's realize this profit if we can do it. That's more than 80% of the original maximum of $112 that we could have made. So let's right click on this, create a closing order, and buy that put back. Let's submit a limit order of 19 cents, maybe even 20 cents. Let's just do 20. Try to increase the likelihood of a fill. Even though we might feel like we're being generous here, though, it's not a guarantee that that order is going to work. It's not a guarantee that it'll fill. But let's click confirm and send. Buy that put back for a maximum of 20 cents. Max profit, max loss. We don't really worry about this because this is a closing transaction. There is a potential commission here, though, if the order fills. So it could bring the total cost up to $20.65 to fill this order. Let's send that order off. A lot of you saying, yeah, Cameron, let's do this. Okay, we're done. That one, we're out. That's a realized gain. Into it for $112, out of it for $19. Now remember, we didn't pay $112. We were paid $112 and only cost us 19 cents to wrap that thing up, or $19. So that is a profitable trade now closed. It also frees up the cash that was dedicated to the possibility of having to buy shares, and we can go do something else with that cash. Next up, we have Wells Fargo, another covered call. With this one, we sold the $80 call, which was an in-the-money contract at the time, with the objective to potentially, hopefully even, get assigned, get called out. In this case, we were discussing, and this is going back to, here we go, this discussion, using covered calls to exit stocks, right here. It's the second one in our list. But in any case, sometimes a trader who's decided, you know what, I wouldn't mind selling these shares. They may sell an at the money or even an in the money contract, giving someone else the right to buy their shares at a discount, but they're getting paid to do that. We collected, in this case, $1.72 in premium, and we're just holding on to that and waiting, hopefully, to get assigned at $80. If we bought the shares at 70, sell at 80, that would be a $10 profit, plus our 172 premium collected. It would be a total of $11.72, setting commissions aside, $11.72 per share realized gain if we can accomplish assignment. Right now, shares are a little bit out of the money. So here the trader's preference might actually be for the stock to rally a little bit, but I'm going to let that work. If you want to go back and revisit the logic of this trade, you see where that link is in the webcast archives out there on the Trader Talks channel. Now, finally, we have our Walmart covered call. Same logic as the Wells Fargo. This one, the theory here is we put ourselves in the shoes of someone who bought the shares for 60. They wanted to now sell those shares for 90, so we sold that $90 in the money call. And right now, the stock is trading at 102, so that is solidly in the money. Assignment is quite likely in the next 11 days. Now, it's not going to happen in paper money. There is no early assignment in paper money. That's very different from real life. Real life, early assignment can happen, yeah, but not in paper money. But in this case, we'll see. If it's still above 90 at expiration, that contract will get assigned with very, very rare exceptions. So that one's looking fine too. So there's our existing positions. We had a couple that needed some attention. NVIDIA, closed that one out. XOM, oh, we never did actually did we not do a covered call on XOM? What am I talking about? Yeah, with XOM, yeah, I talked about ABBV, so let's go to XOM. Let's go back here. There we go. Clicked on the wrong thing. But with XOM, this is a stock that we bought. We talked about selling the 115. Why did I not send that order? Maybe I just got ahead of myself. All right. Anyway, yeah, let's see if we can sell that 115 call. Did it? I swear I put in that order. Did I not? I'm gonna have to go back and watch the archive. This is saying we have a position. Sure. Oh, I know what happened. Yeah. Okay. Yep. This is simple, guys. When you first place a trade and you've created groups, like I have a group where I have my covered calls and short puts positions. I also have a group for my Getting Started with Options webcast series. New positions that are placed in that account are initially allocated to the unallocated area. So there's our XOM. I was in kind of Twilight Zone land there for just a moment. Let's right click here and move this to our covered calls and short puts group. Now, just because it's sitting down there and unallocated doesn't mean that it's a naked call at that point. It's still in the same account. We still own shares in one spot. We still sold a call in another spot. In that same account, it's a covered call. We just needed to move it to the same group. So now we can see it sort of in the same area as a covered call. Not a cause for panic, just a cause for a bit of Twilight Zone feeling for the presenter. Anyway, there we go. So now let's go have a look at what's going on with the markets. And I did want to talk about, as we have our discussion about the markets, why it's not much of a seller's market for covered calls and short puts, and yet some sellers are totally fine with that. But the first thing I want to have a look at is what's going on with the stock market. Let's put ourselves in the shoes for just a moment of a hypothetical trader who's looking to maybe sell a naked put, or a short put, maybe looking to enter into a new covered call trade. And market conditions have been pretty good for both of those strategies for a long time now. Not every trade works out because individual trades can have their own minds, right? But with the S&P 500, it's been a bullish run for a long time, including most of the last 12 months. We're trading right up close to all-time highs. And let's say that our would-be short put or covered call trader is still bullish on the S&P. Both of the strategies that we're discussing are bullish strategies. So if markets continue to rise, it's likely in that scenario that either strategy will be cooperative as well, just like it has been for us so far. So that's what's been going on with the stock market. You know, some technicians might look at this and say, maybe there's a little bit of overhead resistance here, but in the face of the strength of the prevailing trend, maybe they're okay with putting on new trades. I'm going to put one on out here for the 21st of March. But I wanted to spend a little bit more time talking about not the stock market, but the options market. Is this what we call a seller's market? And how would we even address that question? Well, I'm going to bring up a different chart that's known as the VIX. It's a chart of the anticipated volatility of the S&P 500. And just to bottom line this, typically, as this chart goes, so goes the pricing of a lot of premiums out there, maybe most premiums on most stocks. When this chart is high, premiums across most stocks tends to be kind of high. They tend to be kind of high. And for some, they would call that more of a seller's market. If prices are high, that's generally when people want to do things like sell their house, sell while prices are high, sell their car, sell while prices are high. With options, they also prefer to sell while prices are high. So when we see spikes here, that can lead to a lot of options being at higher premiums than they are typically. When this chart is low, as it is right now, let's draw a line right here where it is right now and just carry that all the way back through the last 12 months. Under these conditions, a trader might say this is maybe more of a buyer's market, especially if we look at over maybe the last 7 months, 6 or 7 months. If you look at where we are right now and where this chart has been, the majority of the time in the last 6 or 7 months, it's been higher than it is. So what I can say with a high degree of confidence is that for most stocks, most of their options have been higher priced at other points over the last 7 months than they are right now. So for our hypothetical covered call or short put seller, what that translates to in real life is that they'll go look to sell a call or to sell a put and discover, wow, I'm just not getting the premiums I used to get. This is kind of a ripoff. What's going on? Well, really, this is just a chart of anticipated volatility of the S&P 500. And when the S&P is expected to be more volatile, that can create higher demand for options from speculators who are looking to optimize on big moves, or from hedgers who are looking to reduce the volatility in their portfolio. In any case, it can increase the demand for options and drive the price up. So when prices are higher, as I mentioned, some people see this as a seller's market. So why might somebody look at this and say, you know what, prices are lower than they have been most of the time, and I'm okay with that? Well, explicitly, it's because volatility is lower. Risk might be lower, so they're okay with accepting lower premiums because if volatility doesn't kick up, if prices don't change rapidly, that might just mean there's less risk in doing so, less risk in accepting premiums at the moment. That's it. So that's kind of a backdrop for what's going on with options premiums, and we are going to be selling a covered call today. And as we do that, I wanted to talk about 2 potential stock candidates. Now, as we move to these stock candidates, there are a few possible prerequisites that a trader might look for their potential covered calls. Number one, maybe they're looking for stocks in specific sectors where they don't already have representation in their portfolio and they're looking to diversify. Number 2, price per share can play a significant role because when we're selling covered calls, we have to buy the stock in order to sell the call. And more expensive stocks cost more money to add at least 100 shares to the portfolio in order to sell a covered call. So price can be prohibitive to some. Another consideration is how liquid the stock is. Illiquid stocks tend to have illiquid options, and that can lead to pricing issues on the options, make them harder to trade profitably. But I also wanted to talk about just the pricing of options on a couple of stocks, just to illustrate why the premiums are higher on some and not so high on others. So let's first of all look at IBM. One of the big companies, it's a big company, highly liquid. It's a little bit pricier, but there are a lot of stocks out there that are in the solid triple digits right now. And what are a final thing that some traders might look for, it's not, and the list that I just provided isn't exhaustive, but some of the pre-qualifiers might include things like price and liquidity and sector considerations, fundamentals, but maybe also what's happening with the chart. So what do we see happening with the chart of IBM? Well, since January 14th, the stock has gone up and up and up and up. It had a big earnings announcement, popped up really high, and then recently it's pulled back. Now, on a big gap up, some traders see a strong gap to the upside as being a possible area of support should the price come back down. And that's kind of what we're seeing here today. Another thing that kind of caught my eye with this was the proportions of the move here. Since this January 14th low, we had a strong run up right up to this recent price ceiling. Let's click on that. I'm going to draw a Fibonacci on there. This is just one way that some traders might draw areas of support and resistance, price floors and price ceilings. Nifty little tool. If you don't know anything about Fibonacci's, you can just go to our channel. Let's pop back here to the channel on the home page, or just right here. But you can just do a keyword search. This is why it's such an important thing to be subscribed to our channel. But if you want to learn about Fibonacci's, look, there's a beginner's guide to using Fibonacci's to trade stocks. And could that apply to options as well? Yes. So let's go back to our scenario here. And what our Fibonacci traders might note is that we made this strong move to the upside, and this recent bit of selling off may be seen by some as just profit taking by those that just made a ton of money very shortly. We've come right back down to about that 61.8 Fibonacci, which coincides very nicely with that gap, and maybe they think it's likely to run up from here. All right, so let's set up a covered call maybe for this. But before we do, I want to talk about the premiums on IBM. I'll tell you, premiums on IBM are not what they used to be. Over the last 52 weeks, the last year, in comparison to where premiums have been on IBM at times, premiums right now are fairly low. And I can see that in a couple of ways. First way is to bring up a study on my chart. How many of you use, in the planning of covered calls or other option strategies, how many of you might use or be familiar with the implied volatility indicator on Thinkorswim? Let me add that to our chart. So to find this again, we just clicked on the beaker icon, and I'm going to type in IMP for implied volatility. Choose that from the menu, add selected, there it is. Click apply, and what we're left with here is this green line. Yeah, Ted, you do? Yep, I suspect there are going to be a lot. But this line is kind of like the VIX. With the VIX, it's a broad view of the general pricing of options. This green line is like a VIX, but just for IBM in this case. It's seen by options traders, among other things. It can have other implications, but one thing that it can provide is a general gauge of whether options prices are high or low across the whole options chain on IBM. Now, it doesn't apply equally to every strike price on the options chain, but when we see this line up high, it tells us, yeah, for a lot of options, prices are pretty high on IBM. When this line is lower, it tells us options prices are pretty low. Look at where we are right now. You can see for most of the last year, not all of the last year, but for most of last year, options prices on IBM have been higher. There have been times when it's been lower. Okay? So our trader who's going to sell a covered call right now is going to discover, boy, they would have gotten much higher premiums back in mid-January than they're receiving right now in the early or middle part of February. Much higher premiums. Willis, you're right. It's a flask, not a beaker. Exactly right. I get called out on that all the time. It's been a long time since my high school chemistry class. Yep, that's a flask. Anyway, but our option trader here might just say, man, I got a lot better premium, in January when I sold a covered call than here in February. And yet they might say, and I'm totally cool with that. Why is that? What does this line, what does the VIX tell us again about these contracts that we're getting into? It's not just telling us that the premiums are lower, but it also carries with it an implication why the premiums are lower. That's an important thing. And the reason is there's not as much expected volatility during the time frame of the coming weeks and months. Ahmad says, implied volatility a function of the strike price? Good question. Not sort of. I might have to dedicate a deeper a webcast to that concept, explore that more thoroughly, Ahmad. But I'm going to speak in broader generalities today, if that's okay. Bill says, how much does today's dividend affect price? Bill, yeah, dividends do get priced into options because dividends have an impact on stock price. Stock price has an impact on options. Now, dividends, once they're announced, they're no longer an unknown quantity, so contracts are adjusted for that. But yeah, it does have an impact, Bill, to the extent that price moves have an impact. Ted says, lower expected volatility is a bullish indication often. Possibly, Ted, that might be the case. Yep. But I just wanted to make the point here that premiums are comparatively low on IBM, and yet I'm going to choose this as our trade today versus one where premiums are comparatively high. Let's look at another stock and do a comparison. I'm going to bring up Salesforce. Here's Salesforce. Our technical trader might look at this and in their decision of whether to get into a bullish strategy like a short put or a covered call, they might notice that price has recently come back down to a previous price ceiling right around that 320 level. You can see that's been a price floor 1, 2, 3, maybe now 4 times over the last several months. So maybe this is an important tipping point for price, and maybe our trader thinks that we're likely to go up from here. And as they go to sell a covered call, they might look down at our chart down here that we've learned is an indication of whether premiums are high or low, and they might notice that premiums are pretty high, very much in contrast to what we just saw with IBM. So you might think, well, this is a slam dunk, easy decision. IBM's premiums are lower, Salesforce's premiums are higher, and therefore, if I'm intending to sell options, let's choose the higher one. But why are premiums higher on one and lower on the other? And if you noticed on both, there's a bit of a rhythm to these premiums, running up and down and up and down and up and down, and there is logic to that. Let's go back to IBM. Without even looking, I know that some of you already know what's going on with these volatility levels, these premium levels. What happened here? Third week of April, third week of July, third week of October, and just recently, third, fourth week of January. Some of them were the fourth week, actually. In any case, what's going on? These are earnings events, and earnings events can spike volatility. And when there's an earnings event, that volatility to a speculator can represent a lot of potential. Ooh, if I buy a call and the earnings go really well, I can make a lot of money. Or if I buy a put and the earnings go really poorly, I can make a lot of money. It can drive up demand for options. And at the same time, you have hedgers who maybe own big positions in IBM in their portfolio, and they use options to hedge those positions. In any case, driving up demand from speculators, driving up demand from hedgers, that can influence options prices. This volatility closely tied to pricing of options. So yeah, volatility will tend to spike as earnings announcements approach. It doesn't always, but that's actually a pretty prominent rhythm to the pricing of a lot of options out there. And it's definitely the case recently with IBM. And once the earnings is done, those options prices have kind of crashed back down to earth through an event that we actually have a name for. It's called the volatility crush. It crushes the prices of those options. So a trader who's looking to sell a covered call might say to themselves, hey, premiums are lower, but that's because I don't have to deal with an earnings announcement. And if I put this on, let's put our earnings icons on the chart just so you can see this. Click on the little gear. Let's go to equities, show those corporate actions like earnings, click apply, click OK. Yep, there's an earnings announcement. There's an earnings announcement. There's one, and there's one. So for a trader who's purely trying to get the biggest premiums, if they're selling right here or right here or right here, it's right before an earnings announcement, and that can go either way. If the earnings go well and we've sold a covered call, we don't really get to participate in that price appreciation because we've sold a call and someone else gets to buy the shares from us. If the earnings go poorly, well, the trade can get hammered and we're the owners of that stock, and we might take a big hit. So there are pros and cons to selling high premium calls, just as long as we understand that the reason those premiums are high is because there's a lot of volatility. And that if you look at the Salesforce chart, you can see the very likely reason the premiums are going higher is because traders are looking out on the horizon. They're seeing there's an earnings announcement approaching. So I'm going to go back to our IBM, and this is going to be our trade. Let's suppose we're going to buy some shares and then maybe sell a call up here near these recent peaks. That looks like that's around 265. If I pull this down here, around 265. Let's go to the trade tab. Look to buy shares of IBM at $250-ish, 249. Let's go out here to the 21st of March. How much can we get for 265? Maybe about $2. That's a little bit less than 1%. Now, I earlier made reference to something called the 1% rule, which makes it sound like it's written in granite. Got to get at least 1%. No, some traders are totally fine getting less than 1% if they still think that, getting maybe $200 in this case is still worth the income. Just Me and My Song says, what is the range for implied volatility? There's actually not a prescribed absolute well, if it goes to 0, that's not a good sign. That just means that means there's no expected volatility. How do we get no expected volatility? Well, it means the stock isn't trading anymore, which means bankruptcy, delisting, something like that. The upside, though, there's no cap. So I'm going to sell this 265 call. Let's buy 100 shares on a $249 stock. That's going to be about a $25,000 investment. I'm just going to come to the strike price that we're interested in selling. I'm going to right click on that, either the bid or the ask. It doesn't matter which. We get this menu, and we're going to put in an order to buy a covered stock, which is Thinkorswim's term for covered call. That's going to buy 100 shares and prepare to sell that 265 call for us. Looks like our net debit between spending about $249 on the stock and collecting about $2 on the call gives us a net debit of about $247. Let's say that we're willing to spend a little bit more than that. I'm going to push this up. Let's even say that I'm willing to spend up to the natural to get into this. I'm still submitting that as a limit order, so it's not a guarantee that this order is going to fill. But I'm going to click confirm and send. We're going to buy this IBM covered call, trying to get in for a limit of $247.19. There is a commission here that would bring our total cost $24,719.65. Let's send that order off, and we're in for $247.02. Okay, that's the net cost between paying for the stock and actually the income that was received from selling the call. But I did want to point this out. With IBM, notice we sold the 265 call for about $2. That's less than 1%. And that price, 265, is only, what is that, about 6% higher than the stock is right now? In other words, let me clean up this drawing here and remove our fib. And I want to draw in a line right where we sold that call. That was right at 265. About here. Carry that out to expiration. So the distance between what we paid for the stock and where we're potentially obligated to sell the shares is only about 6%. Up $15 on a $250 stock. That's my rough math. I could be off a little bit. If we compared that to Salesforce, let me just show you how much higher the premiums are here. What if we were to buy the shares right now at $328 and maybe sell the $370 contract? Let's go all the way up here to these recent highs, 370. It's about right here. There we go. If we're buying at 328, selling at 370, that's more like, what's that, 42 bucks higher? That's more like 13%. As a percentage, it's twice as far away before someone has the right, basically, that's what they'd have to pay us, way up here. I wonder what kind of a percentage we could get for that. If we go to Salesforce, go to the same expiration, and we look at the 370 call, that's nearly $5. That's like 1.5%, 1.34%, something like that. So is it a much bigger premium? It is. And it's further away from the current price of stock, but it's because of that volatility. Yeah, so premiums go up and down, but they go up and down for a reason. It's because of the volatility. So if the trader's okay with taking a larger risk, maybe they sell a higher premium. If they prefer to sidestep risk, there's a cost to sidestep risk. Not all risk, reduce the risk, and that is premiums just aren't as rich, basically. All right, guys, we've done what I set out to do today. From here, with our IBM trade, obviously what we'd prefer is for the stock to go up, which is helpful to our long stock position, but stay just below 265 and allow that hopefully to just expire worthless. If it goes, if it gets assigned, whether that's because it went above 65 and got assigned earlier, it was above 65, or even if it's below 265, if it gets assigned, well, we sold the shares for 265, having purchased those for around 249. So is it an unprofitable exit? Nope. But maybe the trader, if they're preferring to keep the shares, they just like the stock to stay below the strike. But everybody, we've accomplished what I set out to do today. I wanted the focus to be on this fact of trading options. Sometimes the premiums are not as high as others, but we just need to understand why. And I think that can reassure a trader who maybe prefers to sell when it's not a seller's market. There actually is logic to that. Others might prefer to sell when it is a seller's market. There can be logic to that as well, just a stronger risk. Will, glad you liked that session. Mighty Mouse, you're welcome. Everybody, we looked at existing positions, checked out the market, placed a new trade within the context of higher and lower premiums, understanding that. So that's what we wanted to do today. I'm going to set you loose, but just a final reminder, if you haven't subscribed to our Trader Talks channel just yet, go down and click on the subscribe button right now. It doesn't cost anything. It only takes a second, but our Trader Talks channel is where we host previous webcasts in our nifty little playlists here. You can also join the live sessions. You can do searches for topics of interest like Fibonacci's. Also would encourage you, definitely follow Barb and me on X if you haven't done that already, and if you have an X account. So you just go to X, find Barb at Barb Armstrong. You can find me there at Cameron May CS. So complete, it's at Barb Armstrong CS. That's what you'll want to look for on X, but at Cameron May CS. But that's the best place to connect with your favorite presenters in between the live streams. Thanks everybody for clicking the thumbs up. I can already see we were about 200 people watching live, and I can see that 63 people already clicked the like button. That's definitely appreciated. That to presenters sounds like applause. It also gives our webcast a boost in the YouTube algorithm, helps us find a wider audience. It lets more people see the webcast, and it just helps more people. So thanks for doing that, everybody. Go enjoy the rest of your day. I don't believe... Yeah, Barb's been keeping an eye on the chats. There was not a survey this time. We'll watch for those in the future. But I'll look for you next Monday for another discussion of trading covered calls and short puts. I also have other webcasts all throughout the week. I'll look for you in those webcasts. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.